Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Hi there, my name's Justin Waite. I'm a small cap investor in the stock market. Why small companies? Because they have the potential to return multiples of your initial investment, but they carry with them a lot of risk. That's why you have to know what you're doing. And when I've been doing these videos, I've got lots of questions from people saying, can you explain this or this or this or this or this? So what I've done is decided to go back to the start and, really cover the basics. Why invest was my first video. Why invest at all? Why invest in the stock market was my first video. Check that above on the eye there. And now I'm going to be looking at how to set up a stocks and shares ISA, okay? And that's what you need to do. First and foremost, I want to go back to basics again. Say, what are shares? If you've ever wondered what a share is, essentially, it's a share of a company. And there are basically two types of companies. There's a private company, okay, and a publicly listed company, or PLC. Now, private companies you may see in your local high street. Well, in fact, they don't have to be small. They can be very big. But they're owned by, say, a person or a family. And you can't buy shares in that company. You can't just walk in and say, in fact, to your local hairdresser and say, the guy who owns it, can I buy a share in your company? He may say yes, but it's a private company. And those shares in that company are not publicly listed. Now, anytime you buy shares via a stockbroker, those shares are publicly listed. That means anyone, any member of the public with spare money can buy shares in a company. And those shares basically are listed on a stock exchange. And I find this very exciting. Any company, right, that's listed on the stock market, you can buy shares in. You can own a piece of that company, that business. So if that business is a good business, you can own shares in it. So if you like, Greg's, for example, pasties or vegan sausage rolls, you can buy a share in that company via the stock market. If you like Apple, you can buy shares in that company, or Amazon, you can buy shares in that company. So all these kind of Tesco's, buy shares, anything, the shoe zone. I don't know why, but you can buy shares in that company. You're not doing very well at the moment, actually. But here are a list of stock exchanges around the world, 10 biggest. New York Stock Exchange, the biggest. Look at that, in the far right there, market cap in billions. That is $30 trillion worth of valuation. Companies, basically, if you add every company up that exists on that market there, it comes to a valuation of 30.9 trillion. So NASDAQ is the second. It's a third the size. Then you've got Japan. Then you've got Shanghai, China, Hong Kong as well. And then Euro, that's a lot of them put together. Amsterdam, Brussels, Dublin, Lisbon, Oslo, and Paris there in one. But the biggest one in Europe, single-handedly, is London. But it's a tenth the size of New York. And so many of the companies or shares you'll be buying will be listed in London, okay? So how do you make money in shares? There are two ways, okay? There's the old buy low, sell high. Buy, sell, sell, sell. Now here's a chart of Barclays, okay? This is Barclays in 2017. Let's say you bought 1,000 shares in Barclays at £1. Now, they always quote in pence like that. So it's 100 pennies, okay? And then, that was in March. And then the following August, so in August of that year, they'd risen to £3. You thought, okay, I'm going to sell that 1,000 shares at £3. Now, of course, they cost you £1,000. You sold them for 3,000. You've made £2,000 profit. That's the share price rising. You bought low, you sold high. That's the traditional way to make money, and that's the way you can make big money in stocks, because small cap stocks can rise a lot faster than that. They can also fall a lot faster than that. So that's why there's high risk. That's called capital appreciation. You own a bit of capital in the company there, and that has risen, and you've sold for a profit. It's quite hard to do. An easier way is via dividends or income. I mean, there's less chance of getting rich on dividends, but it's a more stable way of earning money. So some companies pay you part of the company's profits each year, called a dividend, okay? Now, only established companies, pretty much, companies that are generating lots of profits, will pay dividends. Fast-growing startups won't, because they haven't got the cash. They need all the cash to plow back into the business to invest it, reinvest it, and grow the company. When they start earning lots of profits, then they'll pay the shareholders a reward. For basically, the shareholders risk their own capital to invest in the company, so they pay rewards, and hopefully it'll buy the loyalty of the holder, so they'll hold the stock. Now, a dividend-paying company pretty much every year will announce how much they intend to pay in dividends. Okay, and it's based loosely on the profits of a company. If they've done very well, they may up the dividend, and they may pay even a special dividend. The dividends can be paid once a year, twice a year, quarterly, depends on the company. All right, but they call the entire amount that they pay out in the year a full dividend. Okay, so the chairman may stand up. It may not stand up, of course. It'll be done in a statement. The chairman will say, let's say the chairman of this company, the shares are £1. Okay, he will say, this year we're offering a full year dividend of 5 pence. That's how chairmen speak, apparently. So if the shares are £1 and they're offering dividend to pay a dividend of 5 pence, then you can understand that's 5%. That's called a yield of 5%. So that's how they work it out. Okay. Now it'll always be denoted in pennies per share. So what happens here? If the share price drops, for example, after the chairman's announced that, not straight away, of course, but maybe a couple of weeks or months for some reason. Let's say the whole global market, economy, stock market starts going down because there's a bit of worry. The chairman's already announced, though, he's going to pay 5 pence for every share. And let's say they go down to 50 pence. It's quite extreme, I know, but for sums, it's a lot easier to work out. Let's say the shares are now 50 pence. That dividend is still 5 pence. So the yield there is now 10%. So the yield has gone up as the share price has gone down. Now, if you're holding shares at £1, you won't be happy that the share price has gone. You've lost half your capital investment in order to increase the 10% dividend. But if you bought in at 50 pence and you think, okay, they're going to stay here, bottom out here, the shares will be quite stable here. If anything, they could go up. Then you can earn money, 10% on the dividend, and the share price going up. See, so total return can be very good. So that's why dividends are very good. Now, the most powerful thing about dividends, okay, are what's called dividend reinvesting. Now, what happens is when you've got your stockbroking account, you'll be paid the dividend, and it'll go into your account in cash. But you can choose to take that as a reinvestment. So it's called dividend reinvestment. So you don't take it in cash. You basically buy more shares in the company, okay? Automatically reinvested. You can set up your account to do this. And that's very powerful because that creates compound interest. And Albert Einstein once said, compound interest is the 8th wonder of the world. And this is how it works out. Look at this column here, this spreadsheet, okay? I've got £1,000 invested with 10% gain taken each year. So you take that in cash. Let's say the company offers 10% dividend. It's quite high, I know. Very few companies will offer that. So let's say you took the £100 and just spent it. Okay? Just went about buying sweets and handbags, whatever. Let's say you didn't do that with another experiment, another company. Let's say you had another company you invested £1,000 in. They paid 10% dividend. You had to reinvest those dividends back into the company. So you didn't take them. I didn't spend them on sweets and handbags. This is the difference. So year one, £100 for column A, which is the green column, and also for the blue column, £100. But that's added to the £1,000 in the blue column, you see. Year two, £100. Now, look what's happening in the blue column. You're going to get, see that difference every year column? You're going to get £110 in the second year, because it's being paid on 1,100. That's 10% of that. And this compounds up. Every year it increases, look. That 10% is on the entire amount, so it builds and builds and builds. Till at the end of 20 years, that £1,000 becomes £7,400. Now, if you've taken all that, that dividend every time it's paid to you, and invested it on sweets, handbags and clothes, you'd only have got £3,000 there. So reinvesting the dividends, you've got more than double your money. That's on 10%, of course. That's a good return. Let's look at it in a real-life experiment here, or real-life example. The power of reinvesting dividends, £1,000 in the FTSE 100. FTSE 100 is the biggest 100 companies in the UK, okay? This is what would have happened. If you invested £1,000 in January 2000, okay, by the time you got to April 2017, you'd have more than doubled your money if you'd reinvested the dividends. If you'd just taken those dividends and spent them on fancy stuff, then you wouldn't. In fact, the difference is 20% return without dividends reinvested, or 119% with dividends reinvested. Okay? That is the difference. Okay, let's look about setting up a stocks and shares account right now. First and foremost, what you have to know is this. There are two different types of accounts. I know it's complicated again, very complicated. But there's a stocks and shares account, a normal account, and there's a stocks and shares ISA account. You have to go for the stocks and shares ISA account. Why? Essentially, your annual ISA allowance is £20,000. That means you put £20,000 into this account every financial year. So from April to April, you put 20 grand in every year, and it doesn't matter how much you make on those shares. So let's say you buy the next Apple and you become a billionaire. It's tax-free. Let's say you get paid loads of dividends as well. It's tax-free as long as it's within that ISA. Okay? Now, if you've done very well in a stocks and shares account, not an ISA one, a non-ISA one, a normal one, and you'd sold shares and you'd made over £12,000, then you have to pay capital gains tax on everything above that £12,000. All right? So, first and foremost, take up your ISA allowance for £12,000. Okay? Now we're going to have a look at some accounts. So here I am at a website called money.co.uk. I'm not affiliated to this. I just did a search. This came up as one of the searches. I did a search for best stock and shares ISA. Okay? Now, searching for the best account is a bit tricky. It's a bit like finding a good phone contract or new phone. It's that kind of thing. You have to do a bit of searching. But I was lazy. I went with the bank. I have a current account with Barclays. It's not the best. I've heard people whinge about it. I've always had good customer service with them. But charges are pretty much like for like. It's not a huge difference, So go with someone you trust, someone you're familiar with. Have a look around. But pretty much I went with my bank. I was lazy. So here's a list on their site. Hargreaves Lansdown, very well known. A lot of people are with them. I have friends who are with them. In an interactive investor. And here you can have looks of, you can invest, £100 lump sum, smallest lump sum there, or £25 a month, so you can invest like in that way, put the money in that way. They've got over 2,500 funds, and it's very similar. They're all quite any lump sum, £25 a month. They're all very similar here. £10 a month there, Scottish Friendly, AJ Bell, Legal & General. So you've heard of all those. Fidelity are very big, of course. Barclays down here, any lump sum or monthly amount. So they're all very much like for like. All right, so go with what you're ever, someone you can trust, someone you've heard, but they're all like for like. I'm just going to have a quick look on Barclays here. So this is Barclays. Anyway, I'll start using your new 2009 ISA allowance of 20 grand a day. So that's what you can put in every year pretty much, unless they change the limits. Normally limits go up. They have them for a couple of years, depends on the Chancellor. So you can log in and apply. So that's what I did, because I had an account already with Barclays. Very quick, took me about 10 minutes to get opened. So you've got the benefits here. Why choose Barclays? They've got some things here. Look, use our cost calculator. So I've used this before. How much does it cost? So let's say, for example, you got 10 grand you want to put in. All right, let's put it down here. 10 grand investment account. Next, so how much your portfolio is between funds and other events? Let's say 50-50, okay? Funds and individual stocks. How many transactions? Say you're going to do 10 a year, say one a month, that's quite a lot, but just in case. Next. So that's the cost per year from Barclays, third-party managers. So if you got 10 grand, that's 1.43% it'll cost you a year. So that's including charges for dealing as well. So hopefully that makes sense. It's obviously not a lot. If you've got 10 grand, you should be doing a lot more than 1.43%. That's the only kind of thing you do in the bank. That's why you need to invest in the stock market. Did this video make sense to you? Comment below, please. Yes or no. Okay? If yes, that's fine. If no, please ask me a question. I've been happy to clarify, because in my head, it went quite smoothly. In your head, you've been thinking, what the heck is he talking about? I have no idea what he's on about. So let me know. If it made sense to you or not. And also, if you did like it, if it made sense to you, hit that like button just below. That's very easy. And also, if you want the next video, don't forget, hit the subscribe button, okay? And the notification bell. You'll only see the bell after you hit the subscribe button. But that means you'll be notified whenever I release a video. If you just hit the subscribe button, you won't be notified, okay? You'll just see it when you come on YouTube. Now, in the next video, I'll be looking at the easy way, the low-cost way, the low-risk way to gain exposure to the stock market. In fact, just buy shares and stocks via funds, okay? It's a very easy way to gain exposure and a good return on your money, and it beats banks and everything else over the long term, okay? We're doing that next. Don't forget. See my face there? There. Hit that subscribe, notification bell, and there's some more videos for you to watch right there. Hope that helped.